Hello and welcome back to another Hola Prime Academy video. In this video we'll be talking about a very simple trend following strategy, which I call the rainbow strategy. Now, full disclosure, there's not a lot revolutionary about it, but what it is would be a trend following strategy that employs several moving averages, and it gives you an idea as to where the market goes. It has a clear set of rules, when to get out, when to get in, etc. And as a result, it does make it rather simple. So the first thing I would say is that you can do whatever variation you want, but in this video, what I'm going to do is use four moving averages, the 10, 20, 30, and 40 exponential moving average, to give you an idea of how to do this. Now, you can use whatever moving average you want. It all pretty much works the same, although I would say you want to use a wide band. You don't want, for example, 5, 7, 9, 11, because it would be too tight. You want to see when the market has truly shown which direction the momentum is going. So in front of you, you have the Australian dollar versus US dollar 1 hour chart, and you can see that there are four moving averages on the chart. And like I said, in my example, I will use the 10, the 20, the 30, and the 40 exponential moving average. The red is the 10, the orange is the 20, the green is the 30, and the blue is the 40. As you can see, there are times when all four moving averages move in the same direction and spread out quite nicely. There are also times where they cross each other. So the question then becomes, how do you use this? It's pretty straightforward, really. What you are looking for is an area where the moving averages start to spread out like you see here on the chart, and you trade in that direction. It's really that simple. Now, when do you get out? Well, you let the market tell you, and that's one of the better parts of this trading strategy. What you're waiting for is in this case 10, the shortest moving average, to cross below the longest moving average, in this case 40, to tell you when to get out. So the Australian dollar started to give you a signal at 0.6619 or so, and over time you started to see these moving averages spread out quite nicely. At 0.6738, the 10 exponential moving average finally crossed below the 40 exponential moving averages. So you can see that it kept you into the market for quite some time, and basically you just let the moving averages tell you when it was time to get out. So when you enter a trade, you don't really have a target. You want to squeeze it for every last pip that you think you can. And one of the nice things about this type of system is that it is mechanical. You don't have to think much about it. Now, there are a couple of things to keep in mind. One of the problems that you can run into is that there are choppy times. For example, here at the 0.6613 level, about 24 hours before the trade that we just ran through, the 10 exponential moving average started to separate from the others, and you would have had a buy signal. However, about 20 hours later, it crossed over, and you probably took, in this case, about a 5 pip loss. In other words, it is most certainly a trend following system, and that's the one thing that you will have to keep in mind. However, one of the biggest advantages is that it doesn't require a whole lot of thought. And in fact, if you understand how to make an expert advisor, you can program it to just run it for you. And of course, you could change the parameters. So let's take a look at something a little bit more exotic. Why don't we take a look at the New Zealand dollar, Japanese yen? Now notice there are big movements in this pair. You will have times where things get a little volatile like this, and although you will have had a little bit of a gain, you will find yourself going in and out. So you do need to know your environment. That is one thing that I would say. But there are also times where, for example, here on July 17th, the New Zealand dollar started to rally against the Japanese yen, and the two exponential moving averages crossed, but the 10 exponential moving average did not cross the 40 exponential moving average. So although it was very close, this would have kept you in this trade. And that's the idea of using 4, or some people will even use 5 moving averages, keep you in the trade as long as possible. That could have shaken you out if you would have had, say, just the 10 exponential moving average and the 20 exponential moving average on board. This is a huge move because when this started, it was 98.27 yen was the price. And we didn't see the 10 exponential moving average break back above the 40 exponential moving average until we got down to roughly 90.58. So a huge and massive trade. And that's pretty much how this strategy works. It collects huge profits, a lot of little misses. The fact that you have 4 moving averages mean that things that have to line up a little bit better than they do when you get a simple moving average crossover system. So it does keep some of the false signals back. Now, you can see that most recently we've seen this pair cross to the upside with the moving averages. And once we had all 4 moving in the same direction, right about here, you're looking at 89.69. And as things stand right now at recording, you are up about 100 pips and the moving averages are spread out quite nicely. Will that change? Yes, of course it will. But it's not until that 10 exponential moving average crosses below the 40 exponential moving average that you are looking to change your position or close it out, either one. That does bring up an interesting situation where some traders will just simply reverse their position. I don't know that I like that as much. Really, what you want to do is hopefully trade with the longer term trend. That way you don't get chopped up. So if the longer term trend in a market, say on the weekly chart, is obviously bullish, then you're looking to trade in that direction. And as a general rule, that's something that you should always do anyway. So let's take a look at something a little bit different. Let's look at the NASDAQ 100 in the United States. And you can see that this volatile market has recently had the 4 moving averages cross right at about the 18,200-ish area. We started to see a real fan out. And we didn't get the crossover until 19,797 or so. So that is a massive gain again. There are going to be times, like right here, where once all of the moving averages move in the same direction, that you might find yourself stopped out later, giving up a little bit of the gains and maybe getting out a break even or a small loss. But you have to be willing to accept that as a trader. That's just the reality of trading itself. Higher time frames are a little dicier with these. So for example, the daily chart, you could get chopped up, but you can also see where you would have gotten in at about 15,000 and gotten out at about 18,000. So again, that's not a bad thing either. And the most recent move would have been somewhere around 18,000, getting out about 19,500. As long as the market is not going sideways, you will find that the profits that this system keeps you in are going to be much more important and influential on your yearly return than the occasional choppiness.
Hola Prime, trade with transparency.